What's up, everyone? It's Karthik with MoneyVest, and markets here very flat on the day. We don't really have that many trading days left in 2024. Just about 3 more trading days in 2024 left. That's going to be Friday, and then Monday and Tuesday of next week. That's going to be 30th and the 31st, and that's pretty much going to wrap up the third, most likely to be the best year in terms of market gains in the last 20 years. So the markets have certainly been on a great run, and I think we are taking a little bit of a breather as we come into a close of 2024. Of course, there's a lot of analysts potentially putting targets in 2025 at much higher levels, and there's also the other side of the spectrum where targets are being put at a 20-30% discount to where the markets are right now. So you can find both the bulls and the bears in different parts of the analysis and going into 2025. But as we have talked about on this channel, I think it's a very important rule is to never predict what the markets are going to do in the future, because that is always going to be a loser's game. You're not going to be able to do it consistently or accurately, but instead being a little bit reactive and trying to understand probabilities is going to be so much more helpful in your trading and investing journey. And every single day, trading the present, investing in the present, and understanding the market temperature to better understand, whether the markets are worth buying right now or selling or just simply holding and not doing anything. So very important concepts as we have talked about in 2024. But markets overall on the day, very flat. We got the Dow Jones up over 7 basis points, S&P 500 flat, NASDAQ flat. Small caps did increase a little bit, over 88 basis points. And we had the volatility, which is the VIX, up over 3.2%, but still trading at pretty low levels back in the 14s and 15s once again. So if you come over to the VIX summary, you'll notice 14.73, we're back in the normal zone or the 30th percentile. And this number was obviously trading down in the 12s and 13s where we did get that rare signal, right, from the markets. And that's exactly why we like to track volatility. We like to track, the valuations. We like to track the MoneyVest index, the market breadth and technicals to better understand the overall market dynamics, the temperature of the market. Do we need to be aggressive? Do we need to be a little bit more conservative? Do we need to be just, going all in, or do you need to just kind of sit back and trade hedge positions with trading options? That is what the entire goal is, to better understand the market temperature. So portfolio today was down a little bit over $3,300 thanks to Tesla dropping over 1%. At one point, pre-market and overnight trading, it was trading back up to 473. Then of course, as soon as the markets opened, we essentially got sold off, and 450 was at support. We traded below that level, but then we traded back above that level. So it's a little bit back and forth. NVDA, I think, was also slightly down. So if you come over to Max 7, you'll notice that Tesla, of course, was the big loser, down over 1.7%. Amazon down almost 90 basis points. Netflix almost 90 basis points. Meta was down. Microsoft, Google, and NVIDIA was slightly down, just a little bit under $140. And Apple is on a consistent win streak. If you come over to the weekly time frame, it's been 5 consecutive weeks of Apple being green. This would be the 6th week, which I believe hasn't happened since 2010. So if you take a look at this performance from Apple, 1, 2, 3, 4, 5. 5 consistent weeks of green that Apple has already closed. And this week, Apple is up 1.7%. So unless Apple drops by over 2% tomorrow, I think these gains are going to hold up, and this would be creating a record for Apple. 6 consistent weeks of green since 2010, not to mention the market cap is now officially only $80 billion away from hitting a $4 trillion. So Apple's seasonality in December has been very strong. After the 3rd week of November, it has just been ripping from 224. It's up almost 16%, getting up to $260. Dan Ives, I think, put a price target of $325 or closer to $315. I could be wrong, but in around those levels that Apple could get up to. And of course, that's going to be surpassing over $4 trillion market cap. That's a huge milestone for Apple. So it's on a 5-week winning streak of 2% gains or more, the first time that's occurred since 2010. Tomorrow, it will go for its 6th straight week if Apple is able to close green and above 2% tomorrow. The 10-year treasuries are also getting up to over 4.6%. We'll come back to that in just a minute because this is certainly going to be rifling up the markets a little bit moving forward, especially in 2025. But the Money Vest Index sitting at 3.26, so still in the neutral zone. Of course, this was the first and only, perhaps, buy trigger of 2024. That was December 18. That was right after the Fed meeting, and we did see buyers stepping in, and the market's pushing right back up to near all-time highs. But this is the whole idea behind these high-quality signals, is to take advantage when these signals get triggered, right? So it's not about a buying opportunity every single day or on every single dip, but when the circumstances and the environment gives us the best risk reward, that's when we buy. That's when we actually take advantage. And that's what I personally do. That's what I've been using for a really long time. So market snapshot wise, we did have a little bit of a mixed market, with of course some sectors, some stocks doing well versus others. And this right here is where we are with the market snapshot. The Dow Jones in a dip, a little bit under 4% from all-time highs. NASDAQ is just over 1% from all-time highs. We got the S&P 500 also just less than 1% of all-time highs. So we are very, very strong. I mean, these market pullbacks and sell-offs are just normal market circumstances. And this right here is going to be the entire snapshot for individual stocks. Apple, the only company that's trading near all-time highs at the moment. And just under a $30 billion sell-off, very, very flat. And Magnificent Seven over $71 billion. And the biggest gainer for the day was Broadcom, up over $26 billion, 2.3% gain. And Apple here, of course, coming in with a $12.5 billion, very, very close to its $4 trillion market cap. So again, if you want to guys join our MoneyVest community, we're going to be doing a private members only live stream going over 2024 recap and then going over 2025 best stocks to look into, the best strategies, the best ways to hedge, what to expect. We're going to be going over all of that in a private members only live stream. Of course, you'll be able to get access to all the members only videos, the options portfolio, as well as my long-term portfolio. Everything is going to be broken down. Link's going to be down below if you're interested in joining. And of course, save 2 months, 2 free months with that 16% annual discount that also expires at the end of this month here. This right here is market seasonality. So as we know, since 1928, December has had one of the highest probabilities of us seeing green by 74%. And I've also broken it down into a separate spreadsheet. So this right here has been the monthly gain or loss for S&P 500 in 2024. And what you'll notice is that, of course, January, February, March, very strong. April was brutal, down over 4%. And the summer months were fantastic. May, June, July, August, September, these 5 months were just phenomenal. Then October, of course, down 1%, and November was the best month of 2024. And December has been very flat. It's actually one of the worst performing positive months of 2024. Again, April, October, we were red. December, we are very flat because of how crazy the markets have been, especially after Jay Powell. And so we are only up 9 basis points, despite, of course, having a very strong probability, 70%, that we're going to be higher by an average and median gain of almost 1% or more. And so we still have 3 more trading days left. We'll see what happens in December. But so far, it's been, of course, underperforming as per the seasonality right now that we're witnessing. And that's also just goes to show that November kind of, overshadowed its own seasonality. I mean, November, 75% probably that we're going to be up by 1.5 to 2%. It was up 5.7. So you could argue that it was up 3 times more than the average November seasonality. So December is kind of taking it slow and steady. It's a little bit weaker because of how much we already went up in November for the entire market. Now, this right here is a statistic that absolutely blows my mind. This was from JP Morgan, and they essentially put together a return list of different retail traders, and they've essentially put down retail traders are lagging the S&P 500. So groups posted second weakest gain when the index posted a positive return since 2015. Believe it or not, retail traders are up 9.8% this year when the S&P is up well over 26%. This just blows my mind. I mean, like in a year like this year, 2024, how are retail traders not up at least 20%? Like at least 20 should be like the bare minimum, because it's really years like this where you want to do majority of the catch up, because on the years when the markets are down, it can be really brutal, right? It can be really disastrous. And the best outperformance comes in when you are performing better than the S&P 500 in both in terms of risk and return. So you could be generating the same level of return at a lower level of risk, and that would still be outperformance. You could be generating the same level of risk as the S&P 500, but slightly better return. That is also outperformance. And on the way down, that works the same way. You could be down less than the S&P 500, and that is going to be considered as an outperformance. But you could be down more than the S&P 500, but you are also taking more risk. So on a risk-adjusted basis, you might still come out as outperforming the S&P 500. So risk is really the key component in trying to understand outperformance. Now, this is, again, part of the picture. We don't know how much risk retail traders collectively are taking. Maybe they're taking a lot more risk than the S&P 500, and so 9.8% would be considered underperformance. But if they are taking a lot less risk than the S&P 500, then of course 9.8% could be still considered as an outperformance. So I hope that makes sense. But 9.8%, nonetheless, it's still really, really low considering what we have discussed on the channel in 2024. All the strategies, everything that we know. It's still something that we need to increase. We need to get this number up, because this is why we're doing this video. This is why we're producing this content, is to help retail traders and investors better understand the market dynamics, buying opportunities, risk reward, trading strategies, all these different things. That's what we're trying to get across, is to help the retail trader become more efficient in their trading style, their trading and investing style. So spread the word. I think it's going to be super important. This right here is going to be, again, the rolling performances of the S&P 500. So we're on par with closing in yet another very strong positive year. But if you take a look at the rolling averages of 15, 20, 30 years, it is near 98 to 100% positive. Now, I actually look at another spreadsheet, which was very, very interesting. And what this shows us is the annual return probabilities for the S&P 500 over different time frames. So what is this telling us is that if you buy the S&P and just keep it for 3, 5, 10, 15, 20, 25, and 30 years, these right here are your probabilities, percentage probabilities, that you're going to be higher or lower depending on the return. So in the previous spreadsheet, I broke down positive, right? Positive is very, very vague. Positive is only over 0%. So over 0%, the statistic that you see over here, that on a 15-year rolling period, if you invest in any 15-year rolling period, there is a 98% probability that you're going to be higher. 20-year is near 100%. How is that comparing to the probabilities here? That's over 0%. That's positive. If you come over to 15 years, that's 91% probability that you're going to be positive with a return of over 0%. 20 to 30 years, we're looking at 94 to 97%. So again, near 100% probability that you're going to be over 0%. You're going to be positive. But nobody wants to be just positive after 15, 20, 30 years. We want to be making over 5 or 7 or 10, 12%. Now look what happens when you look at those numbers, right? 2.5%, 5%, 7.5%, 10, and 12.5%. Let's just go with 5%. So on a 15-year rolling period, the probability for us to be up 5% annually is only 55%. It comes down to a little bit of a coin toss as opposed to being near 100%. If you look at 30 years, it's a little bit better, almost 60%. Now, if you look at 10%, right? Because that's something a little bit more average on the S&P 500. So being up 10% per year on a 15, 20, 30-year rolling period, the probabilities are absolutely trash. 16%, 10%, and 7.5%. And that just goes to show that's a little bit more of a realistic picture of how volatile the markets can be, and the component of risk, how critical that role plays in our day-to-day performance, in our month-to-month and year-to-year performance, because volatility is really eating into those returns over longer time frames. Because if a bear market hits and the markets are down 30%, well, there goes your 5 years worth of gains, right there, or whatever, 4 years, 3 years worth of gains. And so that volatility, when accounted for, can really diminish the probability of positive years. Those are some things that I think really need to take away from this, because a lot out there is all talking about returns and money-making strategies and profits, but not a lot of emphasis is put on the component of risk, which is incredibly important. I would argue even more important than flashing returns. And so, if I go back to, let's say, my portfolio, you'll notice, again, the year-to-date return, just collectively over 32%, almost $250,000. But this also is segregated into multiple different portfolios. I've got an options portfolio that is doing actually a lot better on a risk-adjusted basis then the S&P 500. Then I've got a portfolio which is mostly ETFs. It's like a bedrock for the portfolios, right? So that's mostly got VUG and SMH, right? So they're a little bit more, slightly more volatile than the S&P 500, but they also are generating slightly better return. So on a risk-adjusted basis, I would say that that portfolio is on par with the S&P 500. Now, the third portfolio, which has my Teslas and Palantirs, that has a significant amount of volatility risk, right? It's been moving up and down like crazy, but over the long term, it has been trending upwards. And so on a risk-adjusted basis, that one has also outperformed the S&P 500 because yes, I'm taking on a lot more risk, but I'm also being compensated with a lot better return. And so that's really what you want. If you are taking risk, you want to be able to generate a little bit more returns. And so a risk-adjusted return is what we always look for. Anyway, coming back over to the markets, Bitcoin here is trading a little bit over 95,000. So I'm actually going to be starting a brand new wheel strategy on BITX. I'm very, very intrigued by the 2x volatility shares. These 2x Bitcoin strategy ETF obviously moves very wildly, so the risk is going to be very high compared to just trading regular Bitcoin ETF because it's 2x leveraged. So if you take a look at where we were towards the end of November, like at beginning of November, pre-election, and since then this ETF is up a whopping 90%. At one point it was up over 150%. So definitely very, very volatile, but I will be running the wheel strategy on this ETF moving forward. That's where the focus is going to be in 2025. Going to be trading a little bit Bitcoin, the wheel strategy, as well as, of course, focusing on other stocks and strategies and ETFs as well, which we will discuss, like I said, in our private members-only live stream, which you can join with the link down below. Volatility, as we discussed, back down in the under 15s. Crude oil prices back under $70 a barrel. Now, coming back over to the 10-year treasuries. Uninversion of the yield curve, right? It's been on the news for a long time. There's a lot of speculation that the recession is on the way with the uninversion of the yield curve. And of course, with interest rates so high, affordability continues to struggle. And we're seeing, again, interest rates on mortgages, on auto loans, credit cards, just absolutely going crazy. And a lot of this YouTube videos, algorithm-wise, are now coming to me with these car loans that people are paying off. And it is just maddening. It is maddening how much people are paying in interest on their $150,000 trucks. Absolutely insane. It just blows my mind. Like, are these people not doing the math? Are they simply not just taking the monthly payment, multiplying it by the number of months they're financed for to just see how much they'll end up paying in interest? And this interest on these car loans are going upwards of 20, 25, 30%. Believe it or not, that's how ridiculous this is starting to get. And the banks are taking full advantage of it. The banks, the hard money loans, the payday loans, everybody's taking full advantage of the uninformed consumer with such high interest rates. It's a catastrophe. Like, to be honest, it is pretty bad out there when it comes to just debt, the level of debt the consumers are taking on. And so this obviously could exacerbate the situation even further. Like, that's only going to eventually make it worse if interest rates continue to stay at these levels or potentially go higher. In my opinion, I think we are on our way to slightly higher interest rates. That's why TMF-TLT for me has been a trade which I'm kind of staying off of right now. But of course, a lot of that depends on where inflation goes and what Federal Reserve's monetary policy ends up looking like in 2025, because I've already reduced it down from 4 to 2 rate cuts. And so a lot of that depends on where inflation goes in 2025. Now, coming back over to the markets, starting with S&P 500 here, you'll notice a very nice validation of that support at 6,000. As we discussed, resistance all the way up to as much as 6,100. So again, we're just about 1% away from all-time highs. Another very strong support is going to be 5,864. Coming over to the NASDAQ, a very strong area of demand right about there. You got bought up during this entire dip from last week. And again, resistance and target all-time high sitting just under 20,100. So a little bit over 1%, less than 1% away from all-time highs right now. So a little bit of indecision right now on the day. So consolidation sideways after a very strong pre-Christmas rally. And so right now we're seeing just slight consolidation at the moment. Coming over to Apple, as we already discussed, a very strong momentum higher. 260 is the new all-time high, just sitting shy of $4 trillion in the market cap. Again, just take a look at how Apple has done since November 4th. It's up over 18%, not looking back once, just a little bit of a pullback, but then still got bought up very nicely. Very overbought RSI. MACD, of course, is not sustainable, so something that eventually will see us give us a pullback or a correction. So keep in mind about that. Technicals, overextension on the upside for Apple. Coming over to Amazon consolidating sideways. Resistance is going to stay put roughly at 232. Support level is going to stay put it down at 216. A lot of consolidation sideways here. And a very strong area of demand right about here inside this green rectangle for Amazon. Tesla, on the other hand, once again, struggling just a little bit. So if you come over to the 30-minute time frame, you'll notice that 460 was a clear resistance for Tesla. We seem to be struggling a little bit over there. And I would say that 445, 446, and also 450 is going to be a decent support level to watch for Tesla. So those right there, both of them are going to be some decent support levels to keep in mind. And right now we're just consolidating sideways in that range. You could also argue that we are making a little bit of a lower high here, which could signify some weakness, but then there's also some decent supports. Like I said, here in the 447 to 450 levels, down to, of course, here in the 416 for Tesla. Like low 400s, we got bought up very nicely. A couple days ago, obviously up over 7%. So resistance right now 460, that's what Tesla needs to break out of, and support level, it would need to validate 450 right now. Coming over to NVIDIA, and NVIDIA here really just flat on the day. Push right back up pre-Christmas, breaking out above this resistance again, validating that support at 133, 134. Like I said, I was able to push both my covered calls on NVIDIA and Tesla few months out and increasing my capital gains, unlocking almost $4,000 in capital gains. And so pretty excited about that. And NVIDIA resistance going to stay put at 149, 150 with a very strong support inside this green rectangle sitting at 134 for NVIDIA. Now, Advanced Micro Devices, I've got a video soon to come out on this stock because of how weak it's been and what's the future, what's the fair value, what's the potential for this stock, everything we'll discuss. But this right here is the lower highs and the lower lows. Support level is going to stay put at $116 for AMD, and a very strong resistance that it's battling right now at 126. Meta Platforms consolidating sideways also inside this uptrending channel of higher highs and higher lows. Support level is going to stay put at $600 right now. Resistance all the way up to 636. And another really strong support at 539, 540 for Meta Platforms. Netflix, on the other hand, a lot of consolidation sideways. Resistance all the way up to 942. Support level staying put at roughly around $860 for Netflix. So a lot of consolidation, that is what we're seeing right now for Netflix. Google, on the other hand, a lot of consolidation also. Support level is going to stay put at 183, resistance all the way up to $202, seeing some buyers to step back in, but right now we're seeing a lot of sideways action for Google. Same thing with Microsoft, kind of validating that area of support and demand, sitting roughly in the 430s and 442s. Resistance going to stay put at 455, and a very strong area of demand right about here inside this green rectangle in the sub $400 level for Microsoft as well. And then finally, we come over to PayPal and Visa. So PayPal here, of course, it's been very strong, but on the daily time frame, you'll notice broke down a little bit from this uptrend, validating that next support at $84. And right now, we're just battling through that resistance at 89 to as much as $90. So that is a huge area of supply and resistance for PayPal. And same for Visa. It's coming up to its resistance at 321, support level at $306 per share. A very nice consistent uptrend of higher highs and higher lows for Visa. Finally, we come over to Palantir and SoFi as well. So Palantir, you'll notice, has held up very well. I mean, it's still trading near all-time highs. That just goes to show how strong this entire stock is, despite the valuation, despite the technicals, the momentum and the sentiment is just incredibly strong for Palantir. Very nice, consistent higher highs and higher lows. And this, in fact, is going to turn into a very strong support now for Palantir, validating perfectly at $80 at the moment. SoFi, on the other hand, also just pushing up over 3.6. Resistance is going to stay put at $17 with a support at $14.87. A lot of consolidation sideways in that range. And then finally coming over to Enphase and Costco. Enphase also just consolidating sideways, very nice higher low over here. A little bit of that ascending triangle. We'll see what happens, whether it breaks out above this $76, $77 resistance or not. And the next target is going to be at $83, $84 for Enphase. So a little bit of this higher high and higher low coming in. And then finally we come over to Costco. And we've got, of course, a little bit of a breakdown, recovering back up to that resistance at 960. Support level is going to sit at 919 to 920 bucks for Costco. So hope you all enjoy this video and a complete update on the markets. It's a small red day. We got 3 more trading days left in 2024. 3.26 is where we are, very neutral right now on the Money Invest Index, and seasonality still is suggestive of a pretty strong 2024 again. So we're going to be closing in well over 26-27%, but December we are very flat. So we'll see what happens with the rest of 2024, with just 3 more trading days left. Make sure that you drop a like, subscribe to the channel. Links to our Discord, Patreon is going to be down below if you're interested in joining us. And again, 16% annual discount that does expire in 4 days. So take advantage of that. That's while it's still here. As always, happy investing. I'll see you all in the next video.